Jon Hartley is an economic researcher with Young Voices. Jon, help us understand the state of our supply chain. Help us understand the fact that the Fed is talking about raising interest rates again. How will that impact? Let's talk about excessive money that is still in the economy that needs to be taken out. Let's also talk about the fact that a lot of what we spent during the pandemic and on COVID has also impacted where we are as an economy and in the housing crisis. What is it that is in the economy that not only the administration but the Republicans in Congress need to do to change this economic spiraling out of control that many Americans are facing today, everyday Americans?
Well, it's a very interesting time in that we're seeing inflation for the first time in about 40 or so years. Some of this has sort of been initially triggered by the pandemic and perhaps some supply chain issues, but the trillions of dollars in new spending and deficit spending certainly has been more fuel to the fire. Now, the Fed has been slow to respond to this renewed sort of increase in inflation, and I think it's becoming increasingly clear that the Fed is going to have to raise interest rates more than we maybe even thought it would a few months ago. Most were have been expecting that the Fed would stop its interest rate increases around 4 or 5% to quash what has been about now 6% inflation as of January, both around that for both core and headline measures, whether you include food and fuel or not. But you're absolutely right. Inflation actually hurts the poor the most. The poor spend an outsized amount of their income on consumption-related goods. They spend a disproportionate amount on things like fuel and food. So it really hurts them the most. And so the fact that the Fed is now sort of caught up, but still not has not raised interest rates to the level of inflation, I think it's somewhat concerning in that the Fed hasn't been as fast to respond as perhaps it should. But the fact that inflation isn't coming down perhaps as fast as many have been hoping for with the latest reading from January is a bit concerning. And I think you're beginning to see some major repricing in financial markets right now with both risk assets like stocks as measured by the S&P 500 for U.S. stocks or interest rates, long-term bond interest rates continue to rise. That I think we're sort of entering a new sort of consensus around how high the Fed has to hike to get inflation under control. And that also has a lot of implications for the likelihood of a recession. If you look at sort of the three main causes of recessions in the post-war era, they generally are either things like asset bubbles, like the tech bubble or the housing bubble in the late 90s and 2000s, or are things like pandemics, second, or things like, and the most common cause of recessions are actually Fed interest rate hikes. And so I think the possibility of a recession is really high. And this also ties into the whole federal debt situation that we're facing right now with the debt limit, which the CBO projects will be hit sometime between July and September. But interest rates really matter for this discussion in the sense that the future path of debt changes a lot when interest rates are, say, 4% compared to 1%. Where they had been between 1 to 2% on long-term interest rates. So, if we are in a world where inflation is going to be higher for some sustained period of time, that has a lot of implications for debt as well, and just how soon we actually have to get our fiscal house in order. All this is not great news in general, and there have to be some tough decisions that are made in the years to come. And raising interest rates to quell inflation is also sort of one of those tough but necessary decisions.
Jon, what does it say about the market that all of a sudden mortgage rates are jumping again?
Well, we think about the housing market. Right now, housing...
Jon Hartley. Jon.
I was just going to say, Joel and Jon sound a lot alike. No, I think it says that these interest rate hikes are working, and this is sort of part of the pain the necessary pain that is sort of required to bring down inflation. One of the main, most essential components of the monetary transmission mechanism is through the housing market. When the Fed raises interest rates like it has over the past year by roughly 5%, that's on short-term interest rates. So things like your short-term money market funds, those are all sort of short-term interest rates. But ultimately, you would expect mortgage rates to rise, and that's exactly how monetary policy works. And the purpose is to cool housing markets to some degree. We're starting to see home prices fall in many metropolitan areas around the country, and that's all about cooling down the economy and getting prices to fall or to not grow as fast. And so that's part of the sort of disinflation that the Fed is trying to engineer. Now, how high the Fed has to raise interest rates, how long does it take these interest rate hikes to feed its way into the economy to bring down the rate of inflation is sort of the big question, right? There's this question about Milton Friedman's famous saying about having long variable legs, monetary policy having long variable legs. How long those legs are is still sort of a big research question, and a question that many are trying to figure out in terms of understanding how much tightening is required by the Fed to bring inflation back to its 2% target.